So, alright students, here's the chapter number 2, the terminology of foreign exchange market. In this chapter, we will learn about the various terminologies, various terms used in the foreign exchange market like bid, offer, broker, currency, etc. So, let's start. So, here are some important terms. The first, base currency. Base currency is the currency against which other currencies are quoted. For example, primary base currency is the US dollar against which all other currencies except for Euro, GBP, Australian dollar and New Zealand dollar are quoted. The second is bear market. Bear market is a market in which prices decline against a background of widespread pessimism that is opposite of bull market. The name bear market is derived from the way a bear attacks, that is, strikes downwards with his paws. The third comes bid. Bid is the rate at which a broker is willing to buy the base currency at the lower price of the spread shown. This is the price at which an individual trader will be able to sell the currency. The next comes bull market. Bull market is the market characterized by the rising price. The name bull market is derived from the way a bull attacks, striking with its horn from the bottom up. The next term is broker. Broker is an agent who handles investors' order to buy and sell the currency. The next term is counterparty. Counterparty is the customer or a bank with which a foreign exchange deal is executed. Term number 7, cross rate. Cross rate is an exchange rate between two currencies, usually constructed from the individual exchange rate of two currencies. Cross rate is measured against US dollars. Next term is day trading. Day trading refers to opening and closing the same position or positions before the close of that day, which is at 9 p.m. or 2100 hours GMT. The next term is equity. Equity is a fund in addition to margin deposits available to sustain unreleased losses. Released profits are added to the equity, whereas released losses are deducted from the equity. The next term is flat or square. Flat or square is a position where a client has not traded in that currency or where an earlier deal is reserved, thereby creating a neutral or flat position. For example, bought at $1,000 and then sold at $1,000 creates a flat position. The next term is Forex. Forex is an abbreviation of foreign exchange. Term number 12, long. Long is a market position where a client has bought a currency he previously did not own. Long is normally expressed in the base currency terms. For example, long dollar means short euro. Term number 13, lot. One lot equals $100,000 against another currency. Term number 14, margin. Margin is a cash deposit provided by clients as collateral to cover possible future losses that may result from the client's foreign exchange trades. Term number 15, margin call. Margin call is a demand for additional funds, a requirement by the clearing house that a clearing member brings margin deposits up to a required minimum level to cover an adverse movement in the price in the market. The next term is offer or ask. It is opposite to bid. Offer or ask is the rate at which a broker is willing to sell the base currency at the higher price of the spread shown. At this very rate, An individual trader will buy the currency. Term number 17. Open position. Any deal which has not been effected or reserved by an equal or opposite deal is called an open position. The next term is overnight trading. It refers to position held open at 2100 hours GMT or 9 pm GMT. The broker will charge interest on all these positions. The next term is pip or points. Depending upon the context, it normally refers 1 basis point, that is 0.0001. This basic point works for all currencies except Japanese yen. The next term is short, which is opposite to long. It is a market position where the trader has sold a currency he does not already own. Like long, it normally expressed in the base currency terms. For example, short dollars means long euro. The next term, spread. Spread is the difference in the prices between the bid and offer rates. The last term, volatility. It is the measure of price fluctuations. And now we will discuss about buying and selling in forex market. Buying and selling in foreign exchange market always happens in the currency that is quoted first. A currency price expresses the value of one currency relative to another currency. For example, buy USD JPY means buy the US dollar or sell the Japanese yen. Traders buy when they expect a currency's value to rise and sell when they expect a currency to fall. Buy action will create a long position and sell will create a short position. Please note that there are exceptions and all currency pairs are not quoted in the same order. In some currencies, the US dollar is the nominator, in other it is the denominator. Thus, if US dollar would strengthen, it can have a different effect in the price of different currencies. Let's take an example. Price of Euro USD is 1.3100 and the price of USD CHF is 1.6500. If US dollar should strengthen against both the currencies, it will have following effect on the price of Euro USD and USD CHF. Now, Euro USD will be 1.2900, which is down, and USD CHF will be 1.6700, which is up. The two important terms to remember are rise and correction. Rise means upward price movement and correction means downward price movement. So friends, now we will learn the basic principles of trading. The first is profit objective. Forex trading permits profit taking from both rising, that is bull, and falling, that is bear market. To achieve a profit, a trader should buy low and sell high, or sell high and buy low. The next principle is leverage. Trading in forex market is done through units called lots. Each lot is equal to approximately $100,000. The trader needs to deposit $1,000 into a margin account at the broker to each lot dealt. This establishes a leverage of a ratio of 10 to 1 and as a result the value of each pip movement equals to approximately $10. The margin deposit prevents non-performance between counterparties and serves as a buffer to the broker to close all open positions of a trader. The last principle of trading is zero-sum game. In every currency transactions, you have a buyer and a seller. Thus, one side is winning and another is losing, and as a result, it is referred to as a zero-sum game. But Please understand that this is a false statement because the broker is always a winner whether a trader wins or loses. The broker is always paid in advance as an opening a transaction. This brings to the end of the chapter 2. Thanks for your participation. Goodbye.